Well, g'day there, traders and friends, market participants, and enthusiasts right around the world. You are here with James on behalf of Pivot Point Trading. What I'm going to do for you, it is obviously a late Sunday evening as I sit down and present this market analysis, but what I'll do is just address some of the concerns which I keep hearing about as to non-committal markets. And really what I mean by non-committal markets is currently the state of where the Dow Jones Industrial Average is relative to that of the S&P 500 and the NASDAQ. Generally what we look for in terms of, in many ways, agreement between or against certain markets is to make sure that they are moving in the same direction. And as at the current juncture being Sunday the 20th, it's simply not there at this particular moment. Now, obviously that can change. Markets are always changing. But if you take a look at my screen right now, the Dow Jones Industrial Average is holding up just shy of 18,900. It appears everything once again is A-OK, and that this long-term bullish trend, which we've seen again from those 2009 lows, just continues to progress. It just continues to move forward in the face of, I guess, a lot of weak technicals, and that's fine. It can continue like this indefinitely, but when we see other markets not confirm recent highs in other markets, it is somewhat problematic, because what we're looking for is, again, agreement between certain markets, and really that will, upon agreement, give us the green light that this bullish trend is good to go. So as the Dow Jones Industrial Average again breaks out to new highs, here we are, we have just eclipsed the July and August 2016 highs. Let's have a look at the picture of the S&P 500. When I have a look at this chart, and again, pay attention to this chart, the S&P 500 still hasn't overcome those relative highs. If you look at this, we're still yet to push above those August swing highs, which is somewhat problematic at this point. It doesn't mean that it cannot happen, but if you are to be, I guess, aggressively bullish, or to jump on board with this recent bounce, this parabolic move off from the recent lows in early November, you'd really want to look for confirmation, because as we see these divergences continue to play out, what it's really telling us is that one of these markets, based on which direction it is, obviously, if it hasn't broken above those highs, or if it has, is telling us fibs at this particular point. And obviously, one side of these markets, or the side which differs from the other, is going to have to change. Now, again, the S&P 500 is still below that 2,200 area. When we have a look at the NASDAQ also, it still hasn't posted, or at least held above those recent highs in September and also October. What is happening is that, look, we're still seeing the continuation of this long-term grind higher. It is somewhat ugly, it is somewhat frustrating, but what appears to be happening is that every time we bounce off, in this particular instance, these intermediate trend line, the move higher is losing steam, it's losing momentum. And what I mean by that is, once the move is established, once we see that reversal off from support areas, it seems as though the legs of that move is becoming less and less and less. And what that is showing us, or at least telling us, is that, look, this market to a degree is somewhat exhausted. Now, we can remain like this, it's okay to remain like this, and we will jump on board with this bullish trend, but we need to see price across these markets move in conjunction, move in synchronicity with one another. So as we move into the trading week again, beginning Monday the 21st, yes, momentum is somewhat to the upside, but we still have divergence between these markets. More so and more apparently, I should say, if we have a look at the NASDAQ 100, this is really where the tech heavy, or the big market cap in the tech really reside. You can see on this particular chart right here, we are still quite a way below the highs. Now, that's not to say that we cannot overcome these recent highs which we've established in September and October, but we've been painting this red picture here, this little red rectangle, to say, well, if there is to be a reversal in this particular market, this is generally roughly the area where it will actually take place from. And fast forward, or actually rewind 2 weeks ago, we were pushing up into this 4,825 area. And then on this particular trading session right here, we got that long day, outside day engulfing candlestick, which again suggests that the market is relatively weak, it is somewhat timid, and there are still sellers up and around this location on the NASDAQ 100. We've seen Apple really come under a lot of pressure. It has been in a really, I guess, in a controlled pullback, but it is starting to test some really important trend lines and also structural areas in terms of price, which is somewhat concerning. You're also seeing the same type of event or trading activity take place on Amazon as well. I mean, I can show you some of these movements. I mean, here are the highs in these stocks which we've been following. which really petered out in mid-October. Here we are in November, and these bounces which are taking place really look like bear flags, which doesn't really suggest continued strength into the NASDAQ 100, especially when it's heavily weighted for these companies. Now again, you see Amazon putting in those highs in October. You see this recent pullback which has been taking place. Again, it looks like a bear flag, and what we expect is to see this price, or the price of this share, come back up into these exponential moving averages, which of course are bearishly aligned, and to find them as resistance. On top of that, it also looks like we have a reversal breakaway gap here, and it sets the stage for, again, a possibility to enter into some short positions on Amazon if in fact price can push on up a little bit higher, even as high as $820 to fill this open window. This would still be a bearish picture for the price of Amazon. If we continue with this discussion as well, and just to show you this on the chart itself, have a look at Google as well. You see these long day engulfing candlesticks which have been setting up since late October. It doesn't really paint a good picture moving forward for this particular stock either. Again, we've tried to fill some of these gaps. We've moved back into some of these red rectangular boxes, and what has happened, what has been the result of that? It has been another opportunity to open up short positions. Now, this isn't something that we're talking about long term, but it really looks as though, based on some of these individual companies, that it is going to be somewhat of a headwind for the current highs which we're posting in the Dow Jones Industrial Average. There is a lot of complacency out there by market participants, and it is somewhat aggressive to be jumping into this market or into the US financial markets at this point aggressively long, given that there is some form of a divergence at this point in time between the three widely followed market indices out there, which is what we do in that pro analysis class. So pay attention to that. NASDAQ is another one of those companies right now which has got some severe headwinds. It looks as though we're establishing some form of an island reversal potentially as well. We've got that gap in the opposite direction, a long day Morobozu candlestick. We're right on the edge of this gap potentially filling, which is going to take us down to $100 a share on Netflix, a pretty decent haircut from where we're currently trading at about 115. We'll see how the week begins. But again, a lot of these tech companies are setting up what appear to be bear flags, and these bounces which we're seeing, again, are just pushing back up into those declining exponential moving averages, which present shortable opportunities, most likely when price comes up into that 50 declining exponential moving average. We have to pay attention to the long-term simple moving averages as well. But if you're just paying attention to the Dow Jones Industrial Average, it is somewhat constructive. We are holding around the highs. We are holding these key areas. We are a long way away from the exponential moving averages. So if this is to be proven, we would expect price to remain around these levels, maybe even potentially pull back down to about 18,600, and then potentially a buying opportunity moving forward. But if that was to be the case, and if we are to jump on board with that, we'd want to see the S&P again break above these recent swing highs, and to hold above these levels and confirm what the industrial average is doing at this particular time. The NASDAQ 100, again, same picture. We need it to break above this level to validate what the industrials is doing, which is going to give us more confidence moving forward. These markets have been relatively stagnant for almost 2 years now. And again, a lot of people are somewhat complacent in this most recent bullish parabolic move off from this intermediate trend line. If I go out and show you this on the weekly chart, again, this is going back all the way to 2009, since the lows of the most recent or the past GFC. You can see we've got decelerating fan lines, and this is just the, I guess, the strength of the bullish trend since the trend reversal which took place at the beginning of 2009. You can see the first trend line coming up through here. Pardon my drawing, you've got the second trend line coming up through here. Oftentimes, again, once that third trend line is broken, it will mark the top of a terminal reversal. Now, if that is to be true, which I expect it to be true, you shouldn't be concerned about this market until we really start to crack below some of these swing lows which we put in around mid-2016. You can see these red lines which are sort of projected into the future. At the moment, these are coming in around 4,600 to 4,800. Here we are at 5,300 again, testing these most recent swing highs. So again, this price action, it is constructive on the primary level of the trend because we are holding above, again, the long-term primary bullish trend, the macro trend, which has been in effect since that terminal low in 2009. But what we seem to be doing more often is actually retesting some of these intermediate trend lines. So if you pay attention to this change of, I guess, fractal, what I've done, I've gone from the weekly chart and now I'm into the daily chart. This is the February low. Again, we touched it in the month of June. We've bounced off it, and most recently in the month of November. So we've had 3 touches since February 2016. This is what we call the intermediate trend. And depending on what happens with this most recent bullish move, it's really going to at least allow us to understand what we expect to happen moving forward. If we just continue up off from this level, that would be very healthy, very constructive for the US financial markets. But if we start to crack this trend line, this intermediate trend line, and if we take out this swing low over here, well, then that would suggest that we're coming back down to retest once again that long-term primary trend in the market. Does that mean that there is a reversal on the cards? Not necessarily. But again, when we start doing technical damage, severe structural technical damage, you need to be alerted to it, and you need to understand just what is happening behind the scenes in the markets or for the markets themselves. If you pay attention to this on the S&P 500, you can see the same picture. In fact, we've actually broken this trend line. And you've still got these 3 touches. However, we did break down as we progressed into November. We've seen the parabolic rise. And what appears to be potentially happening is that we're actually back testing this intermediate trend line from the bottom. So oftentimes, when you talk about support and resistance, you look at horizontal areas of support and resistance, and that's fine. But also when you talk about decelerating fan lines, which again can be on the macro scale, when you're talking about the 3 decelerating macro fan lines, but also when we start implementing intermediate fan lines as well, it gives us the same resistance areas. So once this support level is taken out, we can back test that support as new resistance, and sometimes X marks the spot. And really what that means is that there's just confluence between horizontal resistance areas and also potentially back tests of fan lines which have broken and what we expect to hold as resistance. So, I mean, at the moment, as we move into the week, the markets are somewhat skewed. They are a little bit, in many ways, showing a little bit of a divergence between this current strength which we've seen flow into the market over the past 2.5 weeks. And at the moment, we still don't have clear confirmation or at least clarification on where this market is moving towards, or as we round out 2016, and most importantly, where we're going to begin 2017. There's a lot at stake up and around these highs. Oftentimes when markets or individual stocks or ETFs, repeatedly retest or at least hit resistance, and fail, it will usher in a major correction. That correction, if in fact it does happen, will take us most likely back down to this primary trend line. But again, it is still healthy, and it is healthy on the macro trend, bullish that is long term, until or unless we start to break below this level. Now, I'm not suggesting that's going to happen this week. I'm not suggesting it's going to happen this month, but these are the types of, I guess, technical signals, pictures, patterns that we look out for to help us understand where the market is moving, where momentum is moving, and how we can, again, set up individual trades to fit that analysis. Now, we've taken advantage of some trades which have corrected. Others have moved parabolically, again, to the upside, especially the financials and some of the companies encompassed within the Dow 30. That's all well and good, but we are seeing sector rotation. Other sectors are extremely weak, and market breadth, again, remains somewhat bearish. I mean, we've got less than 40% of stocks actually above their exponential moving average, the 50-day, which is sort of indicating at least that the majority of stocks encompassed within these markets are not actually on the same side as what we've been seeing with the broad scale markets as these indices come back up and retest these old resistance areas. That's not to say that, hey, this bullish move isn't legitimate. It just says that at the moment it is, or at least the majority of stocks are just not committed at this particular point in time. So it's something to think about. Think about the NASDAQ 100. In past videos, I've said this is the key, and I still believe it to be the key. Let me just bring up the right chart. I need to bring up the NASDAQ 100 here. And again, we're still at that red box here. And I mean, I don't want to call this a head and shoulders because it really isn't. It doesn't really fit the long-term sort of constructive pattern which we've been looking for in financial markets when they do and will eventually put in terminal reversal patterns. But look, we are still healthy. We are still holding above this macro primary trend. But on the intermediate time frame, unless until we come across or at least overcome this resistance area, there are some major warning signals, especially around this red box, that you need to pay attention to, because if we start to see the crack of this level, especially in the NASDAQ 100, around 4,600, then it really will usher in a retracement back into this long-term primary trend line. And again, this would be potentially a very good buying opportunity if in fact the long-term macro trend is going to continue. But again, if you're at the moment anyway, jumping into both bullish and bearish trade, and you're sort of just not selecting the best trades, or at least not being patient and disciplined in your approach to individual stock selection, it's a time at least to pull back and to wait for these markets to give you a clearer signal, clearer picture of where momentum and where market direction is moving before you actually pull the trigger and allocate capital into some of these individual stocks. A lot of divergences going on between the large caps at the moment and generally what the broader stocks are doing on those indices, but we're still holding up around very close to these all-time highs, but we do have resistance to overcome on the S&P, the Nasdaq, and also the Nasdaq 100, which is very, very important as well to confirm this recent move. So on that note, everybody, have a fantastic Monday's trading session for the 21st. I'll be back throughout the week to update you, but the week just passed. It has been a relatively quiet week, notwithstanding, of course, the Dow being up and around those all-time highs. But even on the weekly chart of that particular market, it was a week where the market itself took a breather. It moved sideways in a constructive pattern, whether that is a bull flag or a little short-term wedge consolidation pattern. Time will tell what happens, but pay attention to those rising exponential moving averages on the Dow Jones Industrial Average, because if we are to see a bounce, it will most likely come from those exponential moving averages, or it will come from this old resistance, which is going to act as new support. Before you act on it, however, make sure that those two other markets are confirming the move by breaking out to those all-time highs and confirming, of course, the legitimacy of what we've seen over the past 2.5 weeks in terms of that bullish move higher. So on that note, everybody, have a nice Sunday evening. I'll be back with you again throughout the week. It is James signing off on behalf of Pivot Point Trading. All the best. Goodbye.